Hi folks, David Waring here again with InformedTrades.com and our third and final lesson in a three-part mini course on intermediate topics in the subprime financial crisis. Now that we have an understanding of off-balance sheet entities and the role that these have played in the crisis, the next thing we're going to take a look at is something which is known as mark-to-market accounting. As you may or may not realize, many of the losses that you're hearing about these banks are taking are coming not from actual realized losses from selling these debt instruments at a loss in the open market, but from write-downs in the value of assets that they still actually hold. Accounting rules require that these firms mark these instruments to market, or in other words, carry them on their books and reflect any gain or loss in the value of these instruments in the tradable market as if it was an actual realized gain or loss, even if the bank continues to hold the instrument. This is an important point to understand for several reasons. In order for these firms to mark these assets to market, there needs to be an actual market where these instruments are trading. The problem now is that there's been so many issues with this type of debt and so many of the big buyers have gotten into trouble that no one wants to touch it. This creates a situation where the market is very illiquid, or in other words, there's very few buyers, so if you want to sell one of these instruments, you're going to take a substantial hit in value. Because of this, everyone is trying to hold on to these instruments, hoping that order and liquidity will return to the market, and hoping that when it does, these instruments will begin to trade at a price which these banks feel more directly reflects their true value. The problem with this is many firms are getting into trouble and having to sell these instruments even at distressed prices, which is all they'll fetch, because they need to raise capital at almost any cost. And when this happens, it creates a chain reaction throughout the financial system, as everyone else who holds similar types of debt has to now mark the value of those debt and take the value of that debt down to the new level, taking a hit to their balance sheet as a result. This is a big problem for two reasons. First, as we learned about in last lesson, these banks are required to hold a certain amount of capital on their books at all times to meet their reserve requirements. When they take write-downs on the value of their positions, this is a direct hit to their capital base, putting many of these banks in a position where they have to go out and raise additional capital to meet their reserve requirements. Secondly, as we learned about in my original series on the subprime financial crisis, these banks rely on the soundness of their balance sheet to borrow money at low interest rates and on the short term, and fund their operations and fund these longer-term debt instruments that are held in these off-balance sheet entities. So when they write down the value of these instruments, it's a direct hit to their balance sheet, putting many of them in a position where they have to go out and raise a bunch of capital like Merrill Lynch and Citigroup did recently, or worse, where they have to sell off some of these instruments at distressed prices, further exacerbating the problems. There are many arguments relating to how aggressive we should be at marking these assets to market. On the one side of the aisle, there is the basic argument that we should be even more aggressive than we've been, forcing the issue, so to speak, so we can get all these problems out of the way now instead of kicking the can down the road, and the argument goes exacerbating the problem. The argument on the other side of that is that if we're too aggressive, then we're in danger of collapsing the entire financial system. So there's many arguments on both sides, which we're actively covering in our subprime financial section on InformedTrades.com. So we hope to see you there. That's our lesson and wraps up our course for today. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And have a great day.